Hello, I'm Ryan Lightfoot-Amanoff, and welcome to the second week of our ISA webinar series. Today, we're joined by Stephen Marshall of the Cordiant Digital Infrastructure Investment Trust, also known by its ticker CORD. CORD owns a portfolio of assets designed to provide the backbone of infrastructure that can support our growing digital economy. It is managed by a highly experienced team who operate a buy, build, and grow approach that is designed to provide an attractive 9% annualized return from a combination of both income and capital growth. As such, we believe Cordiant offers investors a unique portfolio that could provide considerable diversification benefits to a portfolio. To talk us through this opportunity, Stephen will present for approximately 30 minutes before handing back for around 15 minutes of Q&A. You are welcome to ask questions as we go along in the box in the corner, and I will collate these questions and put them to Steve at the end. So without any further ado, Stephen, please take it away.
Ryan, thank you very much, and good morning, everybody, and thank you for joining us today to listen to the story of Cordiant Capital, digital infrastructure. I set up Cordiant Capital just over 4 years ago with Cordiant Capital of Montreal. We listed on the London stock market. We raised money in order to develop the thesis. But prior to that, my history was 40 years as in the digital infrastructure industry, as a multinational corporation executive. I'm not a banker, I'm not a financier. I'm used to running businesses. Initially, I retired from American Tower after 12 years as the president of American Tower, where I built the business up from 15 billion market cap to just under 100 million market cap with a very, very talented team. And prior to that, I ran the biggest mobile tower company in Europe, which we ultimately sold to Macquarie's for over £2.5 billion. I set up Cordiant Digital Infrastructure Limited, listed on the London stock market just over 4 years ago, in February 2021. So let's go into the slides and just give you more information with respect to the business. So CORD, it's very much a specialist digital infrastructure fund. It's different than many other funds in that it has people from industry, as many people, if not more people from industry than we have from banking or private equity. And that gives us an insight into the industry and into the different businesses in which we invest, and gives us an opportunity to be able to work with them, more interactively in the future. We're very much a long-term investor. We've raised money on the London stock market. That's long-term permanent capital, so we can act very much as a strategic investor with these investments, and work with the management team to grow value on a sustainable basis over a long period of time. When we set out to build this portfolio, we wanted a reasonably conservative risk level, so we set out to invest in middle market infrastructure assets in UK, Europe, or North America. So very well developed countries of operation. We look to invest, as I say, in middle market, but using a buy, build, and grow strategy, whereby we look to acquire, very strong, competitive businesses in smaller geographies that have good management teams, and we can support them to both grow the business organically and through bolt-on acquisitions. And you'll see some of that in the follow-on slides. And as with investment trusts, appetite for dividends, we're keen to deliver both not only a dividend, but actually growth in the underlying core asset base, growing a solid NAV over the long period of time. So the strategy that we pursue is very much building out these infrastructure platforms, adding new customers, and adding additional assets through bolt-on acquisitions, or building new assets in terms of mobile towers, if you will, across those geographies that I've already mentioned. And We've also been looking more recently to partner with outside capital to give us more bang for our buck in terms of being able to pursue a wider array of portfolio businesses as we go forward. So there's the investment strategy set out diagrammatically. Invest in the core infrastructure of the internet. We like to call it the plumbing of the internet. So whether you are accessing the internet through a mobile network or through fiber connectivity to the home or other mediums, we are providing a lot of the connectivity in order for you to be able to, and other people to be able to achieve that. We very much operate as a hands-on basis. As I say, I'm an ex-multinational corporation executive. All of the CEOs of the operating companies report to me, and I engage with them on a regular basis, not just at the board meetings, in order to work through the strategy and the tactics and the opportunities that are presented to the individual companies. We have this buy, build and grow strategy across the geographies that I've been talking about. And we have very much a very strong blue chip customer base with long-term contracts. And I'll talk a bit more about that in due course. And those contracts being long-term, I guess you'd be surprised if we didn't say that these contracts did provide for annual inflationary growth indices. Most of them do. We target a greater than a 9% return made up of a cash dividend, currently around about 4.5–5%, and then underlying growth in the net asset value of the business, hopefully driving up the share price over time. There's a strong year-over-year EBITDA growth. You can see if you look back over the last 4 years. We've had very, very good growth in profitability or EBITDA, which is a maximum for cash flows. And as a result of that, we've been able to deploy a very progressive dividend policy, well ahead of what we set out at the time of the IPO. Inherently, I think the investments that we make, whether it be on fiber, whether it be on the mobile operator network, are inherently ESG friendly in that they're offering greater capability to the mass population to be able to work remotely, reduce commuting, reduce carbon emissions, etc. So extremely beneficial and rewarding in terms of what we do, in terms of how we build out the plumbing of the internet across the geographies in which we operate. You can see here the timeline of the business, setting out in 2021, raising just under £800 million, investing very quickly into CRA in the Czech Republic, which is the number one in its business in the Czech Republic and is a great national champion. As a result of the cash flows that company generates, we were able to commit to a 3p dividend to shareholders in the first full year. After that, we acquired a data center in New York, and after that, we were able to again further increase the dividend to 4p as a result of the continuing performance of CRA. We raised additional funds, debt funds at the holdco level, a couple of £100 million euro bond, in order to be able to finance another acquisition, Emitel, which is again very much a similar type of business to CRA in the Czech Republic, but Emitel is in Poland and it's at least 50% bigger than CRA. As a result of the size of the geography and the nature of the business. We were able to close that in November 2022, and then the following year, my old team from American Tower recognized that we had a much stronger position in Poland, and they had a small portfolio of towers which they asked if we'd be interested in purchasing, which we did, and we've integrated those into Emitel. In August 2023, we acquired an exceptionally good fiber developer in Ireland for a couple of 100 million enterprise value, or just under 100 million of equity value. Then we acquired a bolt-on acquisition in CRA, Cloud4Com, which augmented CRA's existing data center businesses with cloud business. So when you own a data center business, you sell space, you sell access to power, but then customers often come along and say, look, we don't have our own servers, could you provide the servers? And it's a natural sort of augmentation of that business. You provide the servers, and that's effectively as a cloud type of business. We very recently, well, a year ago, we acquired some small handful of assets in Belgium, telecom and broadcast assets in Belgium, and then further increased our dividend to 4.2 pence. We've refinanced all of our operating companies' debt balance sheets, and we refinanced the whole co debt of 200 million euros, and now all of our debt goes out to the middle of 2029. So no refinancing risk in respect of the business for quite a number of years now. You might well have seen that we've just closed on a joint venture to acquire DCU and Proximus's data centers in Belgium, which makes us the biggest data center owner in Belgium. And we have signed to acquire BT Ireland, primarily their infrastructure business, their fiber business, which is metropolitan area networks, long distance fiber, and connectivity to B2B businesses. So we've reached agreement to buy BT Ireland from British Telecom, and that's going through regulatory approval now. And we hope that we'll be able to complete on that and merge it with Speed Fibre Group in Ireland, probably sometime the back end of this year. So we now substantially fully deployed all of the capital that we've raised and the additional debt that we've raised over the period of our ownership, and we are with the remaining cash that we have, we'll look to do bolt-on acquisitions or invest both additional cash or organic growth capital in organic growth opportunities. So you can see here, excuse me, you can see here across the 6 legal entities that we own, there is a multitude of assets in the underlying businesses. Over 1,400 mobile telecommunication towers, 76 broadcast towers that deliver broadcast signals from the equivalents of the BBC, ITV, Channel 4 in Poland and the Czech Republic. We have now a lot of data center capacity, both in the interconnect data center that we have in New York, but also the data center opportunities or assets that we have in the Czech Republic, and now the joint venture that we have in Belgium. We have just under 11,000 kilometers of fiber optic network, primarily, of course, within Speed Fibre in Ireland. And of course, if we do close on the BT Ireland deal, then that will get increased substantially there. We have 40 multiplexes, which are a bit of kit actually that allows us to be able to broadcast the television signal from the likes of the BBC in these overseas geographies. And we do offer services in both the Czech Republic and Poland in terms of Internet of Things, so small sensors to remotely measure. Might be water meters, it might be car parking spaces, things of that nature. So a whole host of the plumbing of the internet, if you will, in its many guises, and we service some really blue chip customers, as you can see there, from Vodafone to T-Mobile in America, Verizon, Amazon, Digital Realty, across our data center businesses, and another host of mobile operators. So very good quality customer base that want to have access to our assets over long-term contracts. And as a result of that, as I've said already, we do actually insist that we have escalation clauses in those contracts that can be anything between 10 and 15 years. So driving a very consistent and predictable, growing cash flow stream and profitability. So you can see here a little bit of the history in terms of the financial operating performance. We have actually delivered to date on a NAV basis over 11% annualized NAV since the IPO, rising from £1 where we raised the initial capital up to a published audited externally valued NAV of 124.4p today. Somewhat regrettably, the market cap does not fully recognise that NAV. So rather than buying the shares at 124p today, you can actually buy the shares in the high 80p's today, reflecting a discount, the market cap being a discount to the NAV, which is somewhat disappointing in terms of the outstanding historical financial performance of the business. On the right hand side though, you can see that the darker bars, 1p going to 2p to 3p, those were the projected dividends that we would pay out at the time of the IPO over the following 3-4 years. And you can see that because of the quality of the assets we've been able to secure and the cash flows that we generate, we've been able to pay out a much higher dividend than we'd anticipated at the time of the IPO. So the first year 3p, the second year 4p, in comparison with 2p that we sort of set out as an expectation. And now last year we paid out 4.2p compared with the 3p that was in the IPO document. And we do pursue a progressive dividend policy. So we'll be looking to talk to the board in March 25 to see whether it is appropriate to further increase the dividend at that point in time. You can see down at the bottom left corner there, the EBITDA is well covered. There are certain companies, investment trusts, where they raise money and they give you back a big dividend, but they're not actually covering that dividend in the cash flows that they're generating from the portfolio. So effectively they're taking your equity and they're paying it back to you, pretending that they're actually generating a return. You can see here that that is absolutely not the case. The dividend is covered, if you look in September 24, 4.7 times by EBITDA. If you then take off interest, you take out other operating costs that are below the EBITDA line, you get to free cash flows, and our dividend is still covered 1.8 times after taking all other cash flows out of the equation. So dividend extremely well covered, and as a result, of course, we could actually substantially increase the dividends if we chose to do so, but we like to hold back some cash to reinvest in further organic growth, or potentially smaller bolt-on acquisitions for the opcos. And then on the right hand side, you can see that the gearing has remained fairly conservative, particularly in comparison with businesses of this nature. If you look at American Tower, my old company, you look at some of their competitors in the States, they have much higher levels of gearing than we have here in this portfolio. So the only other couple of things that I would mention on here is probably the figure at the end there of 8.3 times. We bought the portfolio around about 10 times operating cash flows, but because of the discount of the net asset value to the market capitalization today, effectively people can buy shares at this point in time at a 30% discount to the invested capital, which would be around about an 8.3 times. And that's really quite significant, because mobile tower assets are selling in Europe at over 20 times. Data centers are selling in Europe and the US into the mid 20, 25 times EBITDA. So we have a number of very significant embedded assets across the portfolio that really should be valued at a much higher multiple than 8.3 times. I guess the nature of the investment trust market at the moment is that they're not these assets are not fully valued. I guess the only silver lining, certainly from my perspective, is that if the market's not going to fully reflect the full value of these assets, it's a great time to buy. So you may well have seen, and certainly you can go back and you can check it. RNS announcements. I've been continuing to buy, add to my personal holding of the shares over the last 12 months significantly, and I own just under 12 million shares, and I'll probably look to buy more if I can free up additional cash resources within my wider portfolio. So that's certainly the opportunity as I see it at the moment. So let's just look at the markets a little bit. Digital infrastructure assets, the plumbing of the internet. It is a very, very significant infrastructure sector. It's the third largest infrastructure sector behind power infrastructure and roads. And you can see on the right-hand side that there has been and there continues to be a projected very, very strong growing demand for these assets. And it's almost intuitive, I think. We all utilize mobile phones. We're all connecting to the internet remotely, as indeed certainly I am now for this particular presentation. So that's driving more and more demand for capacity on these different digital infrastructure asset classes. It's requiring more capacity across fiber, more connectivity of fiber to business premises or personal premises. It's driving more demand for data centers, more servers in those centers to be able to deliver the information that you need. And it's driving more demand for towers, more lease upon towers as the operators have to put more antennas on the towers to, again, provide more capacity. And there is certainly a need for even more capacity, as we've all seen on our handsets. You're just trying to download a very simple page and you're waiting. And the reason you're waiting is because there is other demand on that particular antenna, and the mobile operators automatically, prioritizing first come first serve to deliver the content. So there is a need for even more, substantial more investment, even just to meet the requirements of today. So a final thought just on buy, build, and grow, which has been a strategy that I think has served us extremely well over the last 4 years, and I think somewhat differentiates Cordiant Digital Infrastructure Limited from perhaps other funds. As I said, we have more industry executives in the fund manager than we have bankers or private equity. So that gives us the opportunity to really certainly have a perspective on the market, where it's going, the competitive scenario, and the growth opportunities. So hopefully we're an intelligent buyer of assets in terms of what we're actually looking to acquire. And I can tell you that we pretty much look at, for every 10 assets we look at, maybe we're only successful in acquiring one of them, and that's because we discount a lot of them in terms of the market position, or we won't pay the price that perhaps some other people are willing to pay. So we're an intelligent buyer. We look to buy really good quality assets. We're looking to buy sizable assets in middle markets. And why do we want to do that? Because we're looking for assets and management teams and businesses which have a strong competitive moat. So as I've already said, we're the number one in the asset class in Poland. We're the number one in the asset class in the Czech Republic. We're probably number two, joint number two in the asset class in Ireland in terms of the fiber. Probably joint number two with BT Ireland. and we are now number one in data centers in Belgium. So really good quality assets in smaller geographies that have these strong competitive moats. And then what you find with the quality of these assets is that they are attractive businesses to work for. Poland and the Czech Republic, respectively, have both won accolades of being top performers, employers that people want to work for. So you get good quality executives in those businesses. And what we want to do is we want to tap into that. We want to work with them in order to be able to drive the growth and the performance of those businesses. So drive growth on the existing assets, get more lease ups on the mobile towers, get more customers across the fiber optic network, get more customers in the data centers. And then we want to encourage them to expand those businesses through further organic growth. So build out more towers, and we build out more towers for the mobile operators in both the Czech Republic and Poland every year. Build out more fiber, which is what Speed Fiber is doing in Ireland. Build out and expand our data centers. When we acquired CRA, they had two or three, I think two small edge data facilities. Now they've got 8 edge data facilities, and they're working on building a 26 megawatt data facility in just outside Prague, where they've got all of the permits to be able to do that, and they're working with discussing with potential anchor tenants before breaking ground. So we really want to work with them to grow organically, and then where they see the opportunity to invest in bolt-on acquisitions with companies that are going to augment their existing infrastructure base or their service capability, then we're keen to support them to do that. So clear example of that is Cloud4Com in the Czech Republic, and adding that server capacity, which is an augmentation of their existing data center business, and then with BT Ireland, which is would be further building a great national champion with Speed Fiber as we integrate both of those businesses and those assets together to offer an even greater and more beneficial service to customers across Ireland and support substantial underlying economic growth across the country. So that buy, build, and grow has certainly worked well for us, served us well over the last 4 years, and we'll continue to pursue that as we go forward. And we build these businesses from sort of smaller mid-cap operations to larger businesses that tend to sell for a much higher multiple, because some of the big investors now it makes it worth their while to invest in these businesses, and they're willing to pay a higher price for them. So just in summary, good performance to date over the last 4 years, showing an 11% annualized NAV growth, some of which has been made up of a cash pay, and obviously NAV growth in the underlying value of the businesses. The last half year, recently announced, we had an exceptional first half of the year, growing EBITDA at over 15%, which is a little unusual. That's an extremely outstanding performance for this type of business. You'd expect these sort of businesses, high infrastructure businesses, to be growing at a lower rate than that. But the team have done an exceptional job in terms of building the business and its capabilities up over the last few years. Dividend cover, as I've mentioned, is well covered, so there shouldn't be any risk to the dividend, and we will pursue a progressive dividend policy, and there's no refi risk either at the opco operating levels in Poland, Czech Republic, etc., Ireland, until mid-2029, as we've extended all of those facilities out to that date, as indeed the Eurobond that we have at the Holdco Centre. It's a highly diversified portfolio of assets across the six legal entities, and we'll continue to pursue further diversification with the cash flows that the business generates, and probably focus primarily on bolt-on acquisitions if we've got a limitation of cash available to us. So very good with that. I'll hand back to Ryan, who may well have received some questions. I don't know, Ryan, have we received any questions?
You have indeed, Stephen. Unsurprisingly, we've had quite a few questions come in, so thank you everybody for those. Please do keep them coming in. Yeah, Stephen, you are bang on timing, exactly 11:30, so we have plenty of time for Q&A. The first one we'll probably start with is where you finished up, which was just on the portfolio and the number of holdings you've got. There are 6 line items in the portfolio and then quite a bias in weight towards the top 2. Can you just talk us through sort of the level of portfolio concentration and how you're diversified by asset?
Yeah, well, thank you very much for the question. Yes, we do have some very strong assets in Poland and the Czech Republic. There is a bit of a skew there in respect to those businesses, but as I said, they are number one in their markets. They're national champions, and they do have a whole mix of different assets, as we were talking about earlier. I'll just flick back to that. There we are, that particular slide. You can see there those different mix of assets. And if I was to, I can sell any of these assets at any point in time. I don't actually have to sell any of the legal entities if I don't feel it's appropriate. But if you look at the left-hand side there, 1,400 telecommunication towers. I could sell one of those. I could sell all of those, right? If I wished. And as I said before, we're probably not getting full value for those towers at the moment. We've got an overall EBITDA multiple of, if you buy the shares at the moment, of just over 8 times. And those mobile towers tend to sell for the high teens, if not the early 20s of EBITDA multiple. So we could actually sell those. Now the question is, should we sell them or should we hold on to them for a little longer? As we continue to grow them. So we continue to monitor that in terms of the market and the opportunity. And again, I mean, we could sell the data center businesses, right, separately. So yes, there is some concentration in terms of the legal entities. The two big businesses being Emitel and CRA. That has been diversified with the follow-on acquisitions, and will be further diversified with BT Ireland acquisition as well, certainly in terms of revenues. So it is what it is, but I feel extremely comfortable with those assets. They've performed well for 4 years, and I expect them to continue to perform well. Long-term contracts, blue chip customers with escalation clauses. So there is a limit to what can go wrong, Ryan.
Great, thank you. And sorry, just sticking on risk for a moment, you talked about some of the refinancing risk being pushed out through your renegotiation of your debt package, but what's the level of gearing across the trust in the portfolio? And then sort of second part of that, where does this put the risk profile of the trust compared to the likes of some of the other infrastructure trusts that people may know?
Yeah, well, there you can see the bottom right-hand corner. The gearing at the moment is just under 40%, 38%. In the IPO, we said we would stay under 50%. But this is a gearing level which is extremely conservative compared with other digital infrastructure type assets elsewhere. The likes of Cellnex across Europe, American Tower in the States. Crown Castle in the States, so very conservative from that perspective. In terms of other investment trusts, well, there isn't really, I guess 3i, has a little bit of digital infrastructure, but it's not predominantly digital infrastructure. I don't think there is a comparable sort of investment trust to ourselves in the digital infrastructure space.
Okay, thank you. And then we'll sort of stick on the digital thing then. One of the big topics in markets and the world more generally has been AI over the last couple of years now. How does this affect your holdings, ranging from the sort of the obvious winners, the likes of data centers, to perhaps sort of questioning some of the fundamentals, things like the towers that support radio and TV? What does the sort of impact of AI and things like that impact those?
Yeah, great question. The assets that we're invested in all benefit from a tailwind, right, in terms of the demand for digital infrastructure. More and more use of mobile phones, more use of working from home, working from offices, needing access to fiber, more demand for servers in the digital in the data centers. So then, when you look at AI, what AI is doing is it's putting more computing power into the data centers, and we'll want to access it, and we are accessing that, right? We're either accessing it over the mobile networks, or we're actually accessing it at home, and therefore that drives even more demand for capacity across the network. More capacity, more antennas on the mobile towers, more fiber, more capacity on the fiber, more electronics on the fiber to be able to deliver the capacity that you need, and more space and more power inside the data centers. But when you look at the broadcast assets as well, AI offers even greater functionality for broadcast delivery. It offers more functionality to be able to understand what customers want, be able to deliver content, have content delivered over broadcast and reside at the end customer equipment. So you could actually take some capacity off the mobile networks, for example, and free up capacity for more interactive work by actually broadcasting data content, video content in particular, Netflix videos, and having that information reside at the end customer equipment. So AI will be helpful in that regard, in terms of understanding what people want, changing the carousel of broadcast content, and giving more functionality, digital ad insertion, etc., across the network, which would drive more revenues for the broadcasters. So AI just helps the whole plumbing of the internet, the whole sort of broadcast infrastructure game.
Great, thank you. And then perhaps looking at some of the challenges of data centers, what about sort of the cost of running those, which has been an issue for the last few months? And yeah, sorry, just that for now. Thank you.
The cost of running data centers. Well, people continue to invest further in data centers. There's more and more capacity needed. There's more and more power needed in order to be able to support the servers that go into increasingly expanding size of data centers. So you do have a number of challenges for that sector of the market. The first one is that there isn't enough power available to be able to meet the demand, right, for the number of servers that need to go in there. So data center owners are looking to encourage governments or work with power companies to be able to deliver more power. Data center companies now starting to look at whether they can generate their own power in order to support their own needs. So that's the first challenge, and it will be an ongoing challenge for quite some time. The second challenge is that all these servers are taking power, and power certainly coming from coal is adding carbon emissions, and there's enormous amount of carbon emissions being generated from the power being used by data centers and the servers that are in the data centers. And again, governments, regulators, the data center owners themselves, investors are becoming wary of this, and are putting pressure upon the data center companies to find ways to move to more green power. So one, they've got a lack of power, and two, they need to get off carbon generating power over a period of time. and increasingly look to improve the efficiency of the servers and the data centers by better insulation, or, placing these data centers in colder areas, placing the data centers where you've got hydroelectric power access, and various, anything that can either save power or reduce the need for cooling, or move it over to green energy. I will say that we've been extremely cognizant of that latter challenge, and investors' preference. We've moved both CRA and the Czech Republic to almost 100% access to green power, or buying the credits, the green power credits, across both those portfolios over the last 4 years. So I don't know whether I've answered the question, Ryan, but if there's a follow-up on that, then happy to see if I can cover it.
Thank you. We'll wait to see if that comes in. Just in the meantime, we've had a couple of questions about the trust itself and the share price. It has rallied quite a lot in the last year or so, which has reduced the discount actually quite markedly, though you are still trading at a wide discount. What are the plans for things like the share buybacks to help narrow this? And what are sort of the prospects, do you think, for that discount to continue to narrow?
Yeah, well, the board has approved a fairly modest share buyback, and we're sort of halfway through that. It's bought about, I think, about 8 million shares back. I mean, I think it's been widely proven throughout the industry that share buybacks really are not necessarily helping the businesses to recover the discount to NAV. I mean, there have been some really massive share buybacks that have just not helped the various trusts revert to NAV. Clearly, what it does do is it means you're buying your shares at a discount to the value of the portfolio, and that's inherently beneficial for the trust. So we have done a little bit, but the other counterbalance to that is that we are very much a buy, build, and grow proposition. So we have these great assets that can grow their profitability both organically and inorganically. So we want to support the management teams and these businesses to pursue those. So we don't really want to use all of our cash to buy back shares when we can find long-term growth opportunities. So we sort of try to walk that line in respect of that. We did, and maybe some of you are aware of. There was a competing digital infrastructure company that launched about the same time as us. Made some very serious missteps, and has now been told by its shareholders to shut it down at a massive loss to shareholders. So for a period of time, I think we sort of suffered a read across from that in terms of, would we be exposed to the same sort of issues? Absolutely, I think that's in the rear view mirror now. We've got 4 years of very, very clear performance. We've got 4 years of paying the dividend that's fully covered, and we're showing good growth. And we didn't invest in assets that do require you to invest, hundreds of millions just to be able to deliver the growth. We don't have to invest in much at all. I mean, we can invest. If we see the opportunity to do so, but we're not obliged to in order to be able to deliver the growth. So it's as I say, I buy more shares. I think it's a great opportunity to do that. We have this issue of the dual fees reporting. We've been engaging with the FCA and government to try and get that resolved. Any cost to the business is included in our share price. So to suggest that you're paying 1% on top of that to the manager is a total nonsense. The cost is already included in the share price. It comes out of our operating performance. It comes out of our NAV, right? So there's that issue. There's effective investment trusts across the piece, and has resulted in, again, discounts to everybody's NAV. And then there's just the challenge of the marketplace, right? In that interest rates were high. Wealth managers were able to shift money from investment trusts to gilts and get the same sort of yield. So they did that, took money out of investment trusts, which reduced the amount of demand. As interest rates come down, you'd expect again that to sort of revert to back more historical norms and help investment trusts generally, start to revert back to the NAVs. But we're seeing additional challenges coming down the pike, with military issues, defence issues that might actually keep interest rates high for a bit longer. So we'll have to wait for that dynamic to play out.
Sure.
Ryan, has that answered the question?
I believe so, yeah. There was a couple of varied questions around discounts. I think that's quite a good coverall. We are at time, but we had 2 more questions that came in just before time. So I'll try and get through those if that's okay. You talked about treading a fine line between balancing cash when managing a discount, but also I imagine a similar situation with increasing the dividend. You've got a good track record of dividend increases, but what do you think the level is of sort of the yield that allows you to pay a good amount to reward your shareholders, but also maintaining your buy, build and grow approach?
Yeah, well, at the moment we have a 4.2p dividend. That's generating on the share price today just under 5%, which is not bad for investment trusts. I guess some pay more than that. We could clearly, as the dividend's 1.8 times covered, we could significantly increase that if we recommended that to the board and the board decided to do that. So I guess it depends on what opportunities we see for the cash, right? If we see really great opportunities, I think it makes sense for shareholders to invest in those opportunities. If we don't see opportunities for the cash, yes, we should give the money back to shareholders through increased dividends or buyback or some special dividend, and we'll always look at that.
Great, thank you. And then the last question that just came in on time was about currency. Do you have what sort of your exposure to currency in those 2 key markets, in the Czech crown and then the Polish zloty?
Yeah, great question. Clearly, we are exposed to currency, both in, I guess, if we extract cash from the business, and whereas there's zloty or the krona at that point in time. I mean, if we knew we were going to extract cash and not deploy it locally, then we would look at hedging as appropriate. But generally, I'm feeling fairly comfortable with the forex position. The UK is not that strong at the moment. It's got all sorts of additional challenges, whereas Poland and the Czech Republic are growing, at almost the fastest rates across Western Europe. So you would expect those currencies to strengthen against sterling, over a period of time. So I think that could be beneficial for us right over time, as we go forward.
Great, thank you. Well, we have had a couple of questions coming after time, but we will respond to those separately. That's okay. Just try and make sure everyone can get up in time for lunch. So that just leaves me to say, Stephen, that thank you very much for your time. It's been a really interesting run through of the trust. For anybody who would like more information on the Cordiant Digital Infrastructure Trust, please visit the Kepler Trust Intelligence website. I believe we have some more information coming out later in March, which we'll write an update for. So if you'd like to be informed of that, please make sure to add the trust to your watch list. And now finally, just leaves me to say thank you very much, Steve, and thank you very much for all our audience for listening and your time today. Take care.